The structural contradiction at $92 silver is trading at $92 after 10 consecutive green monthly closes, yet much of the mainstream narrative still frames this as routine commodity volatility. That contrast should immediately raise a question. Sustained upside of this length is statistically uncommon in any asset class, particularly in a market as thin and leverage sensitive as silver, and yet coverage remains calm, almost dismissive. On one side, Western futures exchanges price silver through layers of leveraged derivatives, expanding liquidity synthetically. On the other, Eastern physical markets continue to show persistent premiums, signaling steady real-world demand. Paper markets imply stability. Physical markets suggest tightening. This is not about a single breakout candle or one inflation print. It is about structural persistence across 10 months without broad retail euphoria or ETF inflows leading the charge. If nothing fundamental is shifting, how does a market grind higher this consistently? The latest PPI data did not ignite silver's move. It validated pressure that had already been building beneath the surface. Immediate context and event breakdown. The catalyst was the latest PPI release. Inflation printed hotter than consensus expectations, reinforcing the reality that price pressures remain embedded in the system. That matters because persistent producer inflation feeds forward into consumer pricing and keeps real rate compression in focus. Risk markets reacted with visible instability, and silver responded immediately. Within minutes of the data hitting screens, price momentum accelerated and pushed decisively through $92, a level that had previously acted as resistance and carried psychological weight for positioning models. This breakout did not occur in isolation. It marked the 10th consecutive green monthly trajectory for silver, a streak rarely observed without structural tailwinds. Simultaneously, Shanghai physical premiums widened relative to Western spot, signaling that the move was not purely speculative futures chasing. Vault reports around the same period indicated continued inventory rotation rather than replenishment, keeping supply optics tight. Intraday volatility expanded as liquidity thinned and stops above resistance were triggered. Why does this matter now? Because 10 months of controlled upside converged with a macro confirmation event. The inflation hedge thesis was not created by PPI, it was validated by it. Beneath the price move sits a more consequential ratio: total registered inventory versus total open interest exposure. That imbalance defines durability. The price level is visible. The structure beneath it is what determines sustainability. Data stack and market plumbing. To understand whether $92 is sustainable, the focus must shift from headlines to mechanics. Open interest represents the total number of active futures contracts outstanding. Each contract reflects a paper claim on a standardized quantity of silver. Registered inventory, by contrast, represents metal that has been specifically warranted and made available for delivery. Eligible inventory sits in vaults, but has not been designated for delivery. The distinction matters. Eligible metal is owned by private holders and is not automatically available to satisfy contract obligations. Delivery obligations are calculated by comparing open interest in a given contract month to the amount of registered metal available. This relationship produces a coverage ratio. A ratio below 1 does not imply default. It simply means not every contract can stand for delivery simultaneously. Futures markets are structured for netting and cash settlement. However, when coverage ratios compress while open interest remains elevated, the margin for stress narrows. Current data shows open interest still meaningfully exceeds registered inventory, though it has rotated rather than exploded during the rally. Vault reports indicate periodic inflows offset by persistent withdrawals, suggesting inventory is active rather than stagnant. The key is whether open interest expands aggressively into strength or contracts through roll cycles. Expansion during rising prices implies speculative participation. Contraction suggests disciplined positioning. Spread behavior provides additional signal. In contango, future contracts trade above spot, reflecting normal carrying costs. Backwardation, where spot trades above futures, indicates immediate demand pressure. Recent tightening in front-month spreads following the PPI release signaled urgency in near-term positioning, though not disorder. Volatility metrics expanded intraday as liquidity thinned after the data release. This is expected when macro catalysts intersect with technical breakouts. Exchanges monitor these conditions through margin adjustments and, when necessary, volatility pauses. These mechanisms are designed to maintain order and manage leverage, not to suppress price direction. Scarcity math adds context. Global above-ground silver stocks must service industrial demand, jewelry fabrication, and investment flows simultaneously. Annual industrial consumption absorbs a significant portion of new mine supply. ETF inflows or outflows can therefore alter liquidity structure rapidly. When ETFs accumulate, they remove float from circulation. When they liquidate, supply re-enters the market. None of these metrics require interpretation through speculation. Open interest, vault stocks, spreads, and ETF holdings are publicly reported. Informed participants verify these data points directly rather than relying on narrative overlays. Structural explanation layer. The tension between paper pricing and physical demand is not evidence of dysfunction. It is a function of how modern commodity markets operate. Derivatives expand liquidity synthetically. Futures contracts allow participants to hedge or speculate without immediate physical settlement. This leverage-based structure enables price discovery to occur in volume far exceeding available registered metal. In stable conditions, this system functions efficiently. Under normal circumstances, arbitrage mechanisms keep premiums compressed. If physical prices rise relative to futures, participants deliver metal against contracts. If futures rise excessively, physical flows respond. The spread narrows through profit-seeking behavior. That equilibrium persists when delivery preference remains low and vault inventories are sufficient relative to open interest. Stress cycles emerge when those assumptions begin to shift. If more contract holders express preference for delivery rather than cash settlement, the ratio between open interest and registered inventory tightens. If vault stocks decline while contracts remain elevated, the coverage buffer shrinks. Add a geopolitical shock or inflation surprise that increases hedging demand, and front-month spreads begin to react. None of this implies imminent failure. It signals pressure gradients within the system. Historical precedent shows that extended silver momentum phases often coincided with questions around monetary credibility and inflation persistence. In prior decades, when real purchasing power was under scrutiny, allocation into hard assets accelerated over multi-month periods. The similarity is not in price targets but in structural sequencing, sustained momentum followed by volatility expansion. In stress cycles, what breaks first is rarely physical supply. Spreads widen, volatility spikes, margin requirements adjust upward to dampen leverage. Exchanges respond mechanically to stabilize clearing risk. These are early indicators long before any physical shortfall materializes. 10 consecutive green months viewed through this lens suggest sustained allocation rather than a short-lived speculative spike. Markets do not grind upward for nearly a year on enthusiasm alone without structural participation. Those who monitor vault flows, spreads, and delivery data recognize these shifts before headline narratives adjust. The informed minority watches plumbing. The majority reacts to price. Countdown. Pressure window. Momentum alone does not define durability. Settlement cycles do. In futures markets, first notice day marks the point when contract holders must declare intent to either accept delivery or exit positions. As this date approaches, participants face a structural decision. They can roll contracts forward into a later month, close positions for cash, or stand for delivery. That choice reveals conviction. Open interest behavior during roll windows provides critical signal. If contracts decline smoothly as traders rotate forward, the market is functioning normally. If open interest remains elevated into first notice while price holds firm, delivery preference may be increasing. That does not imply stress by default, but it reduces the system's flexibility. Now consider the timing. Silver pushing above $92 into settlement windows compounds positioning pressure. Traders short above resistance must reassess risk. Longs sitting on gains must decide whether to secure profit or maintain exposure through delivery cycles. Short-term catalysts cluster around this window. Upcoming Federal Reserve commentary will shape rate expectations. The next CPI and PPI releases will either reinforce or challenge the inflation narrative. Treasury issuance levels influence liquidity, while dollar strength reactions can amplify volatility. No predictions are required. These cycles are structural checkpoints. Price strength into them reflects conviction. Price weakness exposes leverage fragility. Preparation, not anticipation, defines discipline here. Macro overlay. Silver does not move in isolation. Its trajectory sits within a broader macro framework anchored by currency strength, monetary policy, and global liquidity. The dollar index remains a primary variable. Historically, silver demonstrates an inverse correlation to sustained dollar strength, though that relationship compresses during periods of synchronized inflation. A firm dollar can dampen short-term advances, but persistent inflation can override currency pressure if real rates remain constrained. Federal Reserve posture is central here. If producer inflation continues to print above expectations, policy flexibility narrows. The Fed must balance price stability against financial system fragility. Tighter policy supports the dollar and restricts liquidity, yet persistent inflation reinforces the strategic case for hard assets. This dual pressure dynamic defines the current environment. Oil operates as inflation's transmission mechanism. Elevated energy costs filter through production chains, sustaining cost pressures that PPI data confirms. That backdrop sustains the monetary hedge narrative underpinning metals allocation. Geopolitical tension functions as a volatility amplifier rather than a primary driver. It accelerates moves already underway, but rarely creates structural trends alone. Meanwhile, sovereign accumulation of precious metals continues across several jurisdictions, signaling diversification away from purely fiat reserves. Macro forces act as background gravity. They do not dictate daily price ticks, but they shape the medium-term bias that silver trades within. Bull case. The upside thesis does not require speculation, it requires alignment. If inflation persists while real rates remain constrained, silver retains dual support as both a monetary hedge and a critical industrial input. Persistent cost pressures validate hard asset allocation, while structural demand from manufacturing and energy transition sectors sustains baseline consumption. Acceleration becomes possible under specific conditions. An expansion in ETF holdings would signal renewed capital flow into physical-backed products, tightening available float. Sustained backwardation would indicate immediate demand exceeding forward supply assumptions. Continued vault withdrawals relative to open interest would compress coverage buffers. A durable premium gap between Eastern physical markets and Western futures pricing would reinforce allocation asymmetry. None of these factors guarantee price escalation. They increase probability when aligned. Scarcity math underpins the framework. Silver's liquidity structure is thin relative to global capital pools. Even modest portfolio reallocations into the metal can produce disproportionate price reactions. Conditional expansion, not certainty, defines the bullish scenario. Bear case. The downside framework deserves equal attention. A sustained surge in dollar strength could suppress metals in the short term by tightening global liquidity conditions. If risk assets experience sharp drawdowns, portfolio managers may liquidate ETF holdings to raise cash, increasing available supply and compressing premiums. Industrial demand softening, particularly in manufacturing-sensitive regions, could further reduce immediate physical tightness. Positioning dynamics also carry risk. If open interest expands aggressively while registered inventory remains stable, leverage can outpace underlying supply, creating vulnerability to rapid unwinds. In that scenario, price weakness would not reflect structural failure, but a compression of speculative exposure. Margin tightening is another moderating force. Exchanges adjust requirements during volatility spikes to stabilize clearing risk. Higher margins slow leveraged participation and can dampen momentum. Finally, streaks eventually reset. 10 consecutive green months are statistically unusual, and mean reversion remains a structural constant in all markets. Recognizing downside pathways reinforces discipline and protects long-term positioning decisions. Data recap compression. $92 breakout confirmed. 10 consecutive green monthly closes. Hotter PPI reinforcing inflation persistence. Open interest still exceeding registered inventory. Front-month spreads tightening under demand pressure. Delivery cycles approaching with positioning unresolved. Macro backdrop defined by sustained cost pressures. 7 observable pillars. 1 structural framework requiring disciplined verification. Discipline over emotion. Education over prediction. Verify data independently. Control emotion. Structure first, price second.